inspire and guide all our family so that we may always walk in the path of this.
Our guests. My name is Honorable Sudi. I represent an area of Ojoba Federal Constituency. I'm from Enugu State. Thank you.
Thank you, Mr. Chairman. My name is Big Border. I represent the Federal Constituency State. Member of this committee. Thank you.
Thank you, Mr. Chairman. Honorable colleagues, invited guests. My name is Rose Oko. I represent the Federal Constituency in Cross River State.
Honorable colleagues, distinguished guests, my name is Sudi. I represent the Federal Constituency. I'm from Akwa Ibom. Others are yet to come. In due course, you will get to know them. I am Ibrahim Tukur El Sudi, a member representing the Shaka, Kurmi and Sadona Federal Constituency. I'm from Taraba State. Another member is just coming.
I'm Usman Ali Mohammed. I represent the Federal Constituency from Kano State.
I want to enlighten all of us. Well, in the last sitting, I did mention certain things, and I want to repeat it now. My office has been inundated with so many anonymous petitions against certain individuals. Yes, we are not a judicial body, but we may to an extent be considered a quasi-judicial body. We don't just throw documents at us and expect us to act on those documents anonymously. Like some people writing as concerned citizens. You must have an identity. Like the other time, somebody just scribbled a note that I should ask the former MD of Finbank what is his relationship with a particular hotel in Lagos, and some other embarrassing questions. We should not derail from what we are doing here. We are not on a voyage of discovery or a fishing jamboree that anything can fly and we then catch. We are here to investigate the causes of the near collapse of the capital market and then to provide solutions. Where questions arise that need answers, we may pose these questions. So let us not lose focus and start castigating or throwing our passions at individuals. Documents may come. We have rules and regulations of accepting documents. Those that appear before us have been administered off. So how do you expect me or any member of the committee to act on a document whose source we don't know? When the person that appears before us is being administered, giving evidence or not. So please, nobody should think that he can just walk in and dump any document and then expect us to act on such documents. We know what we are looking for. That's what caused the near collapse of the capital market. It has not collapsed, near collapse. So this is basically why we're here, and we should focus our attention on that. The first person to make presentation before us will be CBN. So is there any representative of CBN? The governor is supposed to be here. Can you tell us why the governor of Central Bank of Nigeria is not here?
Stability, which is the subject of this hearing. The governor of the Central Bank is unavoidably absent because he's attending to some urgent official functions outside the country. and that's why he could not be here, and he left before we received this invitation. He attended meetings of the IMF World Bank, as you know, which ended, and then he had to go back to assignments. And the first meeting of this committee coincided with the meetings of the IMF World Bank, of which his certificate must be present. Thank you, Chairman.
Thank you, because I understand you talk about deputy governors.
Yes.
And he has mandated you to represent him.
Yes, sir.
Okay.
Yes. That's the job my function.
Okay.
Yeah.
So, you can go.
Kingsley, Chairman, Morgan.
Do solemnly affirm
Do solemnly affirm
that the evidence I shall give
that the evidence I shall give
before this committee
before this committee
shall be the truth,
shall be the truth,
the whole truth,
the whole truth,
and nothing but the truth.
and not but the truth.
So help me God.
So help me God. Members of the committee, members of the House of Representatives, distinguished ladies and gentlemen, I would like to thank the committee investigating the causes of the near collapse of the capital market for inviting the Central Bank of Nigeria to make a submission to this ad hoc committee of the House. As I had indicated earlier, my name is Kingsley Morgan, and I am the Deputy Governor of the Central Bank of Nigeria with responsibility for financial system stability. Please accept the apologies of the Governor of the Central Bank, Malam Sanusi Lamido Sanusi, for his unavoidable absence as a result of an urgent official and statutory function outside the country. Mr. Chairman, let me begin by saying that the Central Bank of Nigeria is pleased that the House of Representatives is looking into issues related to the near collapse of the capital market of Nigeria. The presentation of the Central Bank will address two areas of this exercise by virtue of the statutory responsibilities of the Central Bank of Nigeria. The first is the macroeconomic implications of the near collapse of the capital market, or the nexus between what happened in the capital market and the macroeconomy of Nigeria. The second is the relationship between the banking sector and the capital market. So those are the two dimensions that we will address. Now, as we know, the capital market and the banking sector constitute major and critical components of the financial system. While the Central Bank of Nigeria is responsible for regulating the banking sector, the Securities and Exchange Commission said is responsible for regulating the capital market. Most of the licensed banks in Nigeria are public, limited, and listed companies on the Nigerian Stock Exchange, the NSE. And during the period 2007 to 2008, 21 out of the 24 licensed banks operating in this country were listed on the Nigerian Stock Exchange. And banking sector stocks accounted for over 60% of market capitalization in the Nigerian Stock Exchange. It is therefore natural, inevitable, that developments in the capital market will affect the banking sector and vice versa. One of the core mandates of the Central Bank, as enshrined in Section 2 of the Central Bank of Nigeria Act 2007, is the promotion of a sound financial system in Nigeria. In addition, Section 31 of the Banks and Other Financial Institutions Act, the BOFIA, gives the Central Bank regulatory powers over the banking system. A key element of the banking sector consolidation program of 2004 to 2005 was the policy pronouncement that increased the minimum capital requirement for banks from 2 billion to 25 billion naira. In order to meet this regulatory requirement, some banks resorted to the capital market to raise funds. And this led to a deepening of the capital market and the unprecedented increase in market capitalization arising from an enhanced consciousness about the capital market among the Nigerian population. At the end of the program in 2006, the banking sector accounted for over 1.21 trillion naira of the total capitalization of the Nigerian stock market, which stood at that time at 2.9 trillion naira. By the end of 2007, the market was already overbought, with most stocks trading at exceptionally high price-to-earnings ratios, which many observers believed, were at variance with market fundamentals. This period saw an increase in margin lending activities, with banks extending credit facilities to customers to buy shares. Market capitalization grew to a record high of 15.3 trillion naira in the first quarter of 2008. Again, over 60% of which was accounted for by the banking subsector. However, from the second quarter of 2008, all the market indices started trending downwards. And by the end of 2008, market capitalization had lost more than 45% of its December 2007 value. And that means that between December 2007 and December 2008, the market capitalization of the Nigerian Stock Exchange lost almost 50% in value. This was generally actually in tandem with global trends, as we will see in a minute. The impact of the global economic and financial crisis. The meltdown in the stock market coincided with the global financial crisis, which adversely affected the Nigerian economy. During this period, Nigeria witnessed a precipitous decline in crude oil prices from a peak of $147 per barrel in July 2008 to $47 per barrel in January 2009. What this meant was that there was a contraction in government and foreign exchange receipts as a result of the low demand for oil occasioned by the collapse in the international oil price and the recession in the economies of Nigeria's major trading partners. The market initially attempted a self-correction in stock prices, but the impact of the credit crunch that had now taken over most of the financial world resulted in a flight to safety for most investors. Mark you, we don't have exact statistics, but we believe that over 60%, and I'm sure perhaps Seth would know better, or the NSC, over 60% of investors in the Nigerian capital market at this time were foreign investors. So the credit crunch resulted in a flight to safety for most investors. The consequent massive selling off of stocks of companies quoted on the NSE by foreign and local investors depressed prices further below the envisioned self-correction and thus precipitated a meltdown in the market. So, to summarize, the impact of the global financial crisis and its contribution to the near collapse of the capital market could be stated as follows. 1. The decision by international fund managers and investors to exit the Nigerian market due to increased risk aversion eroded the value of the market in the wake of the global meltdown. The withdrawal of over $15 billion by foreign portfolio investors further exacerbated the crisis in the capital market. 2. There was a perceived uncertainty in the economic environment, particularly arising from the crisis in the Niger Delta. And this again engendered a flight to safety among foreign investors. 3, there was a panic recall of margin and share loan facilities by banks, which caused many investors to sell their shares. 4, foreign trade support lines earlier granted to Nigerian banks were renegotiated downwards, thereby making them even more expensive in the interim. Making those lines more expensive in the interim. The contraction in the Nigerian stock market occurred in tandem with trends in international markets, such that between end of December 2007 and November 2008, notable markets around the world recorded serious declines. The United Kingdom FTSE 100 recorded a 34.6% decline. The German DAX stock market recorded a 42.2% decline. The Japanese Nikkei market recorded a 44.7% decline. The South African Johannesburg Stock Exchange recorded a 34.1% decline, and the United States Standard & Poor's 500 recorded a 40.5% decline. So this was a global trend. Now, let me speak a little bit about bank exposures to the capital market. As a result of the global financial crisis, which adversely affected the capital market, and as well the oil and gas sectors, the overexposure of Nigerian banks to these sectors through credit concentrations became apparent. Now, during this period, we should remember it was actually characterized by irrational exuberance. The banks became exposed to the capital market mostly through margin loans and proprietary trading camouflaged as loans. Now, this set the stage for a financial asset bubble, particularly in bank stocks. At the end of 2008, the total banking industry exposure to the capital market through margin loans stood at 900 billion naira. And this represented 12% of aggregate industry credit and 31.9% of the industry's shareholder funds. Added to this, was a very severe weakness in risk management practices in banks, poor corporate governance practices, signs of illiquidity, and the stage was clearly set for a major banking and financial crisis that followed. Let me discuss very briefly the initial response to the crisis by the Central Bank of Nigeria. The CBN, warned by the negative developments in the capital market and their implications for financial system stability, took a number of measures with the primary objective of increasing liquidity in the system and to stimulate credit supply through the banking system. These measures included: 1, a reduction in the central bank's benchmark monetary policy rate by 50 basis points from 10.25% down to 9.75%. 2, the central bank suspended liquidity mop-up operations from September 2008. 3, there was a reduction of the minimum liquidity ratio for banks from 40% to 30%. 4, there was a reduction of the cash reserve ratio from 4% to 2%. 5, we expanded, or the central bank at the time, expanded discount window facility operations by doing two things. First, they admitted non-federal government instruments as eligible securities. And second, they extended the tenure of facilities provided under the discount window operations from overnight to 360 days. In addition, of course, the central bank collaborated with the SEC and other regulatory authorities in the efforts to stem the slide in the capital market. But the central bank concentrated its efforts mainly in its area of responsibility, that is, the banking sector. The policy measures that the central bank took aimed at reflating the economy, which started in 2008, actually stemmed the tide, with market indices showing some recovery in the fourth quarter of 2008. Similarly, the subsequent interventions and AMCON, the Asset Management of Nigeria, purchase of the non-performing loans of banks in the fourth quarter of 2010 have had a salutary effect on the market commencing from quarter 4 2010. And we have a graph that shows, in our written submission, we have a graph that shows how, or the linkage between a number of measures taken by the central bank, including the intervention of the central bank in the banking sector as from June 2009, and shortly after that, by the end of the year, given the time lag when some of these measures began to kick into the system, an upward trend in market capitalization began after the central bank's intervention. Now, why was the Central Bank of Nigeria concerned? The central bank was concerned about the cataclysmic effect of a stock market meltdown on the financial system because banks, including their securities trading and asset management subsidiaries, held large positions in quoted companies. And banks, as I have said earlier, were exposed to the capital market greatly through margin lending. As a result of these significant exposures, a number of banks were badly affected, and the liquidity problems ensued in the banking industry because of the significant exposure of the sector. Now, a major market crash would have further impaired the balance sheet of banks and their capacity to effectively intermediate in the Nigerian economy. A persistent meltdown would have aggravated the crisis of confidence that already clearly existed in the banking sector. So, the underlying causes of the crisis and the contributory role of banks. Despite the actions taken by banking industry regulators to stem the decline, the system remained fragile, quite clearly. And the factors that contributed to the fragility and further weakening of the markets included, first, macroeconomic instability. We all know that the Nigerian economy is monocultural, and oil is the major source of government revenue. And the Nigerian banking industry, their activity closely mirrors the international price of oil. When oil prices go up, the banks are awash with liquidity, and when the oil prices go down, most Nigerian banks have liquidity problems. Also, I think it's important to say that given the enhanced capital base of Nigerian banks post-consolidation, coupled with the increase in the price of oil, banks increased the speed of credit creation. But where was this credit going? It was not going to the real sector. The productive sector of the economy lacked the capacity to absorb the increase in lending, and this resulted in credit flows to non-priority sectors and the capital market. Macroprudential management by regulatory authorities also did not sufficiently address these unhealthy developments. The second problem, or the second cause of this crisis, was a major failure in corporate governance and risk management. This was a principal factor in the financial system falling. Risk management practices could not keep pace with the increase in the activities arising from the consolidation of the banking sector. Now, perhaps in the question and answer, if needed, I can provide greater elaboration of the precise state of Nigerian banks at this time. And some of the manipulations of the capital market that were going on in breach and in violation of extant laws and regulations by the management of a number of Nigerian banks. So those are details, and I can provide them if the committee wishes. The third problem was a lack of consumer. And in fact, those manipulations, there is a direct link between those manipulations by the management of some of these banks and the stock market
not that we don't have to make it, we are not supported by the law to get that tax.
Thank you.
Ways and means is a different thing from lender of last resort. Ways and means does not relate to the banks. Ways and means is a relationship to the government, the federal government. The lender of last resort function, as at least we have exercised up to this point, is regarding the banking system. And so it's not bound by that reference, that 5% that you have indicated. So I think that's the clarification. Let me go forward to show very clearly, because I think the time is appropriate and appropriate for me to make a statement about the state of the banks that necessitated the 620 billion intervention. We've never heard this before. Listen, honorables. The percentage of non-performing loans was very high in all the 8 banks in which the central bank intervened. In Bank PHP, the non-performing loans in Bank PHP were 40.86% of the total loans of Bank PHP, totally non-performing. Oceanic Bank, 44.35% non-performing. Afribank, 47.0% non-performing. Finbank, 47.5% of the loans of Finbank were bad loans. Intercontinental, 48% of Intercontinental's loans were non-performing. ETB, 57% of ETB's loans were non-performing. Whenever 77.6% of all loans by Whenever have failed. Springbank, 85% of all loans to by Finbank have failed. This is, by any definition, a massive systemic crisis that calls for systemic intervention, calls for the lender of last resort function, and if that lender of last resort function had not been exercised, I put it to you very clearly, without any shadow of doubt, the financial system in this country would have collapsed, and we will not be here discussing what we're discussing today. We are discussing what we're discussing today because the central bank exercised its lender of last resort function and saved the banking system. Let me also say very clearly that all banks also have serious liquidity challenges, and they could not meet, all these banks could not meet the minimum liquidity ratio of 25%. In addition, the banks were either net takers of funds in the interbank market or enjoyed liquidity support from the central bank. So these banks were already allowed support even before the central bank intervention in 2009. Let me further elucidate, Honorable Chairman, Honorable Members. Now, the ETB, of course we know, in countries like Iceland, the entire banking system simply collapsed and disappeared. All over the world today, many regulators are calling the central bank, inviting us to meetings, they're asking one question: how did you do it? How did you do it? We have a lesson to learn. How did you do it that not one depositor in Nigeria lost a couple in this banking crisis? How did you do it that no bank failed in Nigeria? That's the question. Now, let me further give facts and figures. ETB has 77 billion against it in the standing lending facility at the central bank as of 30th of June 2009. Bank PHP, which was a net taker of funds in the interbank market to the tune of 30.44 billion, and also between October 2008 and June 2009, borrowed 139 billion through the expanded discount window. I said earlier that one of the central bank in 2008 was to create an expanded discount window to keep these banks alive and support. And then again, that PHP borrowed 5.7 thousand billion, that's 5 trillion, through the standing lending facility. Oceanica borrowed 561 billion through the central bank expanded discount window and 2.1 trillion through the standing lending facility between October 2008 and 2009. Intercontinental was a net taker of funds from the interbank market to the tune of 72.4 billion, in addition to an outstanding liquidity support of 81.5 billion from the central bank through the expanded discount window. Africa accessed a total of 3.9 trillion from the Central Bank of Nigeria (SLF) and the expanded discount window to the tune of, again, 3.9 trillion. Finland borrowed a total of 194 billion from the Central Bank Standing Lending Facility and EW facilities, EDW, that's the standard discount window. Union Bank had interbank takings of 108 billion and accessed a total of 291 billion and 1.05 trillion, respectively, through the central bank discount with expanded discount window and the standing lending facility between October 2008 and July 2009. Honorable members, if this is not something that calls for lender of last resort intervention, I don't know what on earth would call for lender of last resort intervention. So, I have given you this, and I have given you more details about the state of the banks. I have not let's discuss, and let me actually show very clearly how the management of these banks contributed to the problems in the stock market, how precisely the stock market was being manipulated, because that's what we're going to discuss. So, I encourage them there.
Okay, please.
Well, second of all, it's very interesting to have a report card written by yourself. Whoever likes a report card for himself, never saw himself as someone must say. It's also a function to have periodic investigation of the state of these banks. You agree? Fine, alright. And the picture you have painted, this horrific picture that was painted of all these banks, they happen in 1 minute. Fine, if it didn't happen in 1 minute, I do also have a mandate to look at the books almost every 6 months. Regularly. So, all of these things, they came to this sorry path under a watch. It happened because, you did not do your activity. If you did all of those due diligence over that period of time, these banks will come to this sorry path. First of all, let me agree with you. We have said it here that in this my presentation, it is included that the regulators do not take all the macroprudential and other steps that they should take. So we, first of all, accept them as an institution, not as individuals. To declare for the record, I joined the central bank in November 2009. The current government was appointed in June 2009. Let the record be clear. However, as an institution, as an institution, yes, that's right. So whether you do CBN today, you see, again, when you showed us what should happen as the magical turnaround of the CBN, you guys wanted to celebrate it. That's why you said, oh, having seen this very, very sorry picture, we need a call to turn around the banks. That's what you're trying to, that's what you're shooting for. But it's clear that your negligence, which you have to admit. Our friends, if you have admitted, then you don't need this picture, you don't need this money, you don't need this contract at all. Let me move on. Let me move on to answer the question the chairman asked. I want to address we want to tell you.
Yes.
The injection issue. Yes. Very quickly. Honorable Chairman, I want to I want to state very clearly that regarding Africa, during its public offer that closed on December 2007, Africa PLC manipulated the share price using a share buyback arrangement. And I want to show how this happened in the capital markets and how this contributed to the crash.
This is not the same document you submitted to us.
I'm reading from my background, Mr. Chairman.
So we have background notes.
Yes.
It's a written submission. Can we have that?
We can provide it to you later, Mr. Chairman.
It's okay.
Please, if I'm not mistaken, the banks control about 60% of the market. So it's a case of, pardon, as a day. Okay. But still a chunk of the market is being controlled by the banks. So it's a case of when they sneeze, the entire market catches hold. Now, Honorable Sudi did raise a very, very fundamental and important question, which we wanted to lecture on. And that is why I want to bring us back to that. Everything happened under the watch of CBN, and I'm glad you have been honorable enough to accept responsibility for that, institutional responsibility, but not that of individuals. Now, there are individuals in that bank that facilitated or contributed to this. Now, it led to a situation whereby a lot of investors in Nigeria lost money, even foreign investors. And confidence in the market is at its lowest ebb. Now, if you did join CBN in 2009 and you discover that investors lost money as a result of failure of regulation, is it the case that those who precipitated, sustained, and profited from these practices are left to go free, while investors who put their money there are left to go home wishing that they don't ever have anything to do with the capital market again? Is that where we are now? Or are there measures being taken to punish those that contributed to these things so that confidence can come back in the market that, look, we have seen that the regulators are alive to their responsibility and they will deal with infractions in the future. But if we allow everything to go, the investors have lost their money, those who perpetrated probably are still in the system or have left. Or if they are still in the system and we are saying the system should follow with these people, it's akin to asking someone with dirty hands to mow a clean pounded yam. It's not going to be possible. So what do we do?
Question. I will return to the point I was making before I was interrupted by the chair in order for you to ask the question. Because that will partly provide the answer to your question. The first point I want to make is that when a number of manipulations took place in the stock market by the management of some banks at the time under discussion, a number of individuals, as we all know, are currently under prosecution in this country for their role or some of the acts that they did that infringe upon the law. And those laws include the Investments and Securities Act. So if you allow me, Honorable, and I will just finish up what I was saying before I will start, you will see the answer to this question. Now, responsibility involved. There is, first of all, the responsibility of the individuals who are alleged to have done or failed to do certain acts. And that is, in this case, either members of management of some of the banks or some operators in the stock market. Now, you then have the institutional responsibility of supervision. And if there is a failure in the institutional responsibility of supervision, it is not a criminal offense. It is a management shortcoming or a failure to perform one's duty. That's different from people who proactively manipulated the stock market. They were not central bank staff. They were capital market operators. And they were management of some of those banks. And that's what I want to give to you in some detail. Now, I want to say that, again, I want to repeat, the central bank has accepted institutional responsibility for the failures of regulation that took place in this country in the last few years. Now, at the time that the intervention was done in the central bank, the choice facing the central bank was, do you save the house that is on fire, or do you go after the rats or the rabbits in the house to see what is going on? You first of all have to save the house that is on fire, and then you can work. We take some measures internally. I'll come to that. But let me say, as I was saying, that Africa, how they manipulated the share prices and what happened in the capital markets. Africa used a share buyback arrangement to manipulate its share price when its public offer took place in 2007. Africa advanced credit facilities to very stockbroking firms. And those credit facilities were utilized in purchasing shares in the names of 1,258 fictitious subscribers. The shares purchased represented 66% of the offer of Africa. We are going to talk about why the capital market crash. Here is why. On the specific instruction of the bank's managing director, the shares held by the 1,258 subscribers were consolidated and ownership transferred to 9 companies owned by the bank and its directors. So the first funds were being used to buy back shares in the stock market. These actions contravened the provisions of the Investments and Securities Act 2007, which prohibit activities that create a false or misleading impression of active trading by engaging in the purchase or sale of a security that does not involve a change in the beneficial ownership of the security. This is the law, and this is how we believe. In August 2006, the management of Finland conspired to engage in proprietary purchase of its own shares from shell companies incorporated by banks, shell companies. The bank instructed 4 stockbroking firms to purchase over 2.8 billion units of its own shares between August 2006 and December 2008. Finland reported that its hybrid public offer was oversubscribed with regards to the ordinary shares, but the fact was not disclosed that they were the ones buying it. Intercontinental Bank was found to have violated several provisions of the Investments and Securities Act. The bank, acting through 3 stockbroking firms, implemented an elaborate scheme to buy back its own shares. Between September 2007 and December 2008, the stockbroking firms bought 3.4 units of the bank's shares, constituting over 29% of the outstanding shares of the bank on the NSE. So there are several other, we shall say, these documents. We are going to x-ray them and see the atrocities that were perpetrated by these banks, either depositors or shareholders. We will ask you questions in relation to that, because that's all these things that happen. So, but again, 25 billion or 2 billion. 89 banks raised or come up to 25 billion. Not like the first one, now you go to the fourth and then step up page. How do you do this? Step up page, so that's the film. And title is the Nigerian Capital Market Crisis. A key element of the banking sector consolidation program of 2004 and 2005 was a policy pronouncement so that was beginning, that's Genesis. Fine. And then what he said was to raise 25 billion, keep that city from 2 billion by 89 grants in 18 months. Alright? Good. Now you have told us how the banks have reacted to that. Everything you have said here, their manifestation, their reactions to this policy. I'll tell you why. Before your policy that they should give 25 billion, they are going to give for free man to want to engage in all of that. We've not seen anything that is bad. So I'm wondering, or free man and all of that. So I'm wondering, are we not putting the cart before the horse? That's number one. Number two, you know what I'm saying? When you witch card yesterday, and the child dies in the morning, you almost want to assume that it's because the witch card yesterday that the child has to die today. So I'm not going to force the dance. I am just looking at the scenario that you're painting. And I'm saying that, why would all of them, without anyone saying anyone, go all out to begin to do the same thing as a solution to an attempt, a way to meet 25 billion now?
I think you see the actions you have taken based on the fractions by the banks. But like the lawyer asked, what is the administrative measure that is needed to take? The bank, the central bank, as a regulator, failed in this duty to oversight the banks properly. And the bank must stop somewhere. And what we are saying is that you are taking measures with regard to some management staff or all management staff of the banks, including shareholders, they are all being punished. Not criminally by you because you are not USCC, you are not USCC. The bank responsibility will transfer to them. But what we are saying, what the government was doing was, what actions have you taken in central bank for the particular desk officers that will oversighting the responsibility of these infractions by banks or who needed to have taken prudent measures to stop these things from happening?
It is the responsibility of the regulated institutions affected by that policy announcement to abide by the policy requirements within the boundaries of the law. So it cannot be an excuse for certain types of activities that the policy announcement was made, and therefore, that's my first comment. Second, there were 24 banks, or there were several banks in fact at that time, about 89. But after the consolidation, I think about 24 banks were left standing. Let us be clear. Not all the banks engage in these types of activities. Indeed, not even a majority of the banks engage in these types of activities. We have, or we believe, indications, and the prosecutors believe they have evidence that 8 banks, or around that number of banks, were the ones involved in some of the things we're discussing. So please let the record be very clear that we're not indicting every bank in Nigeria on capital market manipulations. No, we're not even making such an allegation. But I'm telling you that a number of banks, and it so happened, you talked about the witch that cried and the child that died. It just so happened that the banks in which the central bank had to intervene because they were failing, falling, on the brink of collapse, happened to be the banks that we have some indications to engage in capital market manipulations. So yes, somebody right and somebody right. The question is who? Let me we look at page 4. Don't let us do this. At the end of the program since 2006, the banking sector accounted for over 1.21 trillion of the total capitalization of Nigerian stock market. We did not single out anyone. We said total. Yeah? So, and you know there, he said by the end of 2003, the market was already overbought, with most stocks trading at exceptionally high price to earning ratios, which then begin to appear in the market fundamentals. This is clear. So, a violation of the market fundamentals as a result of ostensibly linked to the policy pronouncement. I know too well that it's not an invitation to breaking the law when we make policy pronouncement. And you are supposed to do that. When you don't matter of that, they also did all of these under somebody's work. That's number one. And then you move on to there to say, and this on this paper, there's an agreement with the fact that practically speaking, you agree that everything that happens, because you now have a graph that shows the trending. I will give to you. Capitalization rate to 15.3 the first quarter of 2008. March 20th of March 2008, and about 60% of which was accounted for by the banking subsector. And that's the however, from the second quarter of 2008, all the market indices started trending downwards. Can you see the dollar comparison? By the end
That's why I realized if everything went well and there was no problem. And if it is true that this 620 billion generated by ways and means, because even money generated by ways and means belong to Nigeria, where is the 620 billion? Is it with CBN? Is it in an account? Has it been paid into Federation account? I think those are things that agitate my mind, and your answer is welcome in this regard. Thank you.
We don't know what happened. Was it a merger? Was it a takeover? Was it an outlet acquisition? Or was it an nationalization? We want to know because people have been jumping all this way. So let us know what actually transpired. Which of these processes or procedures nationalized bank in this country? However, I will leave the responsibility of addressing what happens to those payments to the Nigerian Deposit Insurance Corporation, which was in the lead in that process. He sits to my right, the managing director of the Nigerian Deposit Insurance Corporation. So he will address that question later if he is invited by the other members. So let me not dwell on that. Let me go to clarifications on the 620 billion which the central bank injected into banks. That money was liquidity support to keep those banks as going concerns. That's what it was. It was not the solution to all their problems. Now, those the 620 billion that was lent to the banks, there was an agreement. There was an agreement signed with those banks, with the affected banks, and those agreements were still executed. So it wasn't just free money, and that agreement said we're going to pay the money back. And it so happens that they have paid the money back. Why are they able to pay the money back? Let me try to address that question. Now, you need to also understand that that was just an initial reaction that the central bank undertook to stop those banks from collapsing. The capitalization of those banks, the creation of the Asset Management Corporation of Nigeria, was a major pillar in the architecture of financial stability that has helped us to resolve the banking crisis in this country. The managing director of the Asset Management Corporation of Nigeria is there. I'm sure that it is here. I'm sure that it is invited. We can do greater clarification about what ANCOM has done in terms of buying all the non-performing assets in the banks, or most of it in the banks. And so what we have now is that the no bank I'm aware of, if any, maybe one or two, but I doubt it, has non-performing loans more than 5% of its books. That leaves you pretty much a healthy banking system. I said that no bank has more than 5% of its total loan book as non-performing loans as we speak to you today. And the reason is because of the work that ANCOM has done after it was established at the initiative of the Central Bank of Nigeria and the Ministry of Finance. So because ANCOM has, together with other core investors, will capitalize those banks. Those banks were completely capitalized, the bank loans were bought up, and because their bank loans were bought up, their balance sheets are now much healthier. Now it will take time. It will take time as the government indicated for all these problems to be addressed. But these problems will never be addressed to the extent that we don't have any problem in the banks. Even in the most developed economies today, there are problems of whether or not those banks are lending to small and medium enterprises. There are problems of whether or not they're lending to the real economy. There are problems of how much credit is going to individuals. Nevertheless, we know that over the past 1 year, bank lending has increased quite significantly. The real issue, as many people will say, is the cost of this. But there has been an increase in lending. And we have the statistics we can provide that. So that explanation is that the 620 billion was not the solution to the real problem. It was a preliminary down payment on the solution to the real problem. And the latter part of that solution came through the Asset Management Corporation of Nigeria, buying all the non-performing assets of those banks. And that's what helped to stabilize the banks. The 620 billion was to make them going concerns so that they could continue to do business, while the non-performing problems were sorted out. And that we have done to a very large extent. Thank you, Honorable Members.
Please, DG, you analyze some here. But in life, whatever happens, in conjunction with NDIC and AMCOM, now, you said it is not nationalization, so then it must be expropriation. Yes, it should be. If it is not, if it is not a matter, if it is not, so what is it? Because you see, the Nigerian Investment Promotion Act, under Section 25, guarantees against expropriation. Whenever you foreign investors are, shareholders are saying they have to change. Despite the fact that your primary role is to protect the depositors, not shareholders. That is what the summary of the CA also. Now, Section 25 guarantees against expropriation, and it says, subject to subsection 2 and 3 of this section, no enterprise shall be nationalized or expropriated by any government of the Federation, and no person who owns, whether wholly or in part, the capital of any enterprise shall be compelled by law, whatever that law is, to surrender his interest in the capital of any enterprise. There shall be no accusation of enterprise to which this enterprise by the federal government, unless the accusation in the national interest. National interest, for a public purpose, and act the law which we want to we want to know that unless a of fair and adequate regulation and a right of access to the court for the determination of the investor's interest or right and the right of compensation to it is entitled. And most of this provision that's why we are in those exercise. And we will be able to show complaints and we will have okay. So that you can suppose the process of this law and that of the NDIC section 4. Consolidation and conversion by the corporation. Subject to the approval of the minister, the corporation shall director ensure corporation pursuant shall merge or with any other insured or financial institution subject to the provisions of 5 of section 23. Any or financial institution consolidated with pursuant to the A of this section shall pay any deposit to the savings bank or any other financial Sanusi Lamido did acknowledge our contribution and the fact that our bank examination reports have been robust, have been comprehensive, have been truthful, and we have never used words, in whatever we are doing. A couple of years ago, I think specifically in 2007, 2008, we published the annual report in which we alluded to the health and safety of the banking system, in which we, I think, if I recollect, gave some indices by categorizing the banks as we do as healthy, unhealthy, marginal, and so on. And that caused some ripple effects in certain quarters. That's why
you coming up with this at the time when we want to build confidence, at the time when we just recapitalized the banks and so on and so forth. But we stood our ground. So I just thought that, Mr. Chairman, I should mention this. This is not to say that there will be no areas of improvement. Certainly there will be areas of improvement. One of the things we try to address is the issue of enforcement. Whatever you do, if you don't have adequate enforcement power, you can as well examine banks, you can issue cease and desist orders, you can issue all sorts of regulations. But if you don't have the team to buy it will be difficult for you to be taken seriously. And that is what we've been trying to address. We have already sent proposals to the National Assembly to address some of these issues by giving us, praying that we should be given adequate powers to deal with foreign bank officials, especially those who deliberately refuse to adhere to some of our recommendations, because we've had these issues in the past. If you examine most of our powers are vague, and we cannot do much without collaboration or reference to the central bank. Of course, it's good to collaborate and to share responsibilities and powers. But while you don't even have the powers, you will be seriously handicapped. And we have had situations where we more or less could not assert our positions, as to the misdemeanors that were perpetrated by some erstwhile bank CEOs on account of lack of adequate powers. Mr. Chairman, the issue of weaknesses in the business environment, I think again has been adequately addressed. Now, the issues identified as threatening the Nigerian money and capital markets and which require immediate regulatory responses have been enumerated. And I would like to state, Mr. Chairman, that this happened in March 2008 when we realized that these problems were seriously in the open and they were going to strangulate or bring about the collapse of both the money market and the capital market, and thereby jeopardizing the interests of both shareholders and depositors. So I remember in 2008, in March, we held a meeting with the then DG SEC, Al-Fati, who came to our office, and we held a meeting and we expressed concern and we raised a memo. I have a copy of the memo. To the then governor of the CBN, Professor Charles Sudi. The memo was personally written, former MD, Lejo Gule, in which we raised concerns about what was happening even at that time. And not only that, we sent a copy to Dr. Shamsuddin Usman, who was the Minister of Finance, who also wrote personally to Professor Sudi, urging him to look at these issues. Because at that time, it was a little frustrating because the Financial Services Regulatory and Coordination Committee was not working, meetings were not being held, and so on and so forth. So we mentioned some of the issues in the letter, and this included dissipation of shareholders' funds for share acquisition and manipulation of course by some of the banks, acquisition of all shares by banks through subsidiaries or nominees, huge loans made by banks to selected brokers to prop up the stock prices in the name of margin loans or proprietary trading, failure to ascertain the financial condition of receiving banks by SEC, delay the remittance of subscription monies by receiving banks, delay in issuance of share certificates, lack of protection of investors in the event of unsuccessful public offers. So we raised a memo and raised these issues and asked for collaboration to take place. And on page 6 of our memo, under 6.0, what we call collaborative oversight, of the Nigerian Money and Capital Market, we stated that in response to observed developments that were capable of threatening the safety and soundness of the money and capital markets, the SEC and NDIC held a meeting hosted by the NDIC on 31st March 2008 in view of the potential threat of the emerging trends, and the meeting agreed as follows. Establish a forum for regular consultation and regulatory actions to be taken by money and capital market regulators. Inform the CBN of the initiative and secure its active involvement in view of its status as lead regulator of the banking industry. Ensure information sharing with appropriate confidentiality safeguards and discourage regulatory arbitrage by operators. Organize installation programs for operators by way of seminars or workshops on emerging and wholesome practices. Hold regular meetings. It will be recalled that the NDIC, in collaboration with the CBN and the Federal Ministry of Finance, adopted the bridge bank option to resolve the problems of defunct AfriBank, Bank PHB, and Spring Bank PLC. The action was guided, of course, by the provision of our law, which was extensively quoted, particularly sections 38 and 39. But I want to add that also the action was guided by global best practice as initiated in the resolution failure framework that was recommended by the Financial Stability Board in Brazil. The Financial Stability Board was established by the G20 countries that were obviously worried about the financial meltdown and the need to have a robust framework for resolving, banking crisis, and for the need to have regional and international cooperation so that these issues are tackled, especially where the systemic, there is the problem of systemic failure. Now, the standards indicate in general that the objective of an effective resolution regime is to make feasible the resolution of financial institutions without severe systemic destruction and without exposing taxpayers to losses, while protecting vital economic functions through mechanisms which make it possible for shareholders and unsecured and uninsured creditors to absorb losses, in a manner that respects the hierarchy of claims. In particular, the standards indicate that an effective resolution regime should ensure continuity of systemically important financial services, payment, clearing and settlement functions, protect in coordination with relevant authorities, depositors, allocate losses to farm owners, i.e. shareholders, and unsecured and uninsured creditors, insured creditors in a manner that respects hierarchy. I've mentioned that. Now, very important, not to rely on public solvency support and not create an expectation that such support will be available in view of issues of moral hazard and market discipline. Provide for speedy and transparency as much as predictability as possible through legal and procedural clarity and advanced planning for orderly resolution. And finally, ensure that non-violent firms can exit the market in an orderly way. And Mr. Chairman, I would like to state that these principles, these objectives, were among others what guided the establishment of the bridge bank, which we can talk about maybe in detail later. Now, the standards further emphasize that an effective resolution regime should include stabilization options that would achieve continuity of systemically important functions by way of a sale or transfer of shares in the firms or all other parts of the firm's business to a third party, either directly or through a bridge institution, which is bridge bank, and or an officially mandated creditor financed capitalization of the entity that will continue to provide critical functions. Now, Mr. Chairman, I don't want to read the whole thing so that I do not bore you, but essentially on page 8, we indicated that the three intervened banks constituted about 5% of the banking assets in terms of deposits and loans. This is contained on page 8 of the submission, and also had at least 577 branches and 3.7 million customers across the nation. So it was, as I said in the sermon, that in pursuance of the section 39 of the NDIC Act, and as we have heard after due consultation with the Central Bank, the Ministry of Finance, the Ministry of Justice actually, and the Presidency, I must say, the NDIC established 3 bridge banks for the subsequent transfer of assets and liabilities of the outright Afribank PLC, Bank PSB and Spring Bank on August 5th. The Central Bank of Nigeria subsequently revoked the operating licenses of these 3 banks, and that was again on August 5th. Now, the bridge bank mechanism, Mr. Chairman, I must reiterate, has obviously its own solitary effects. One of which was to preserve and sustain daily operations of the failed banks by ensuring that all the 577 branches of the banks continue to function. To safeguard the bank's total deposit liabilities of 809.4 billion naira. To safeguard 6,667 jobs in the affected banks. To enhance the confidence of both the depositors and creditors of the banks, to prevent systemic repercussion of the failure of the banks on the entire financial system, thereby ensuring financial and macroeconomic stability. Mr. Chairman, as we are aware, the 3 bridge banks were subsequently acquired by AMCON, which injected fresh capital into the banks to recapitalize them by subscribing to 25% of their authorized capital. This brought the shareholders' funds to a positive position and improved each bank's capital adequacy ratio. And we have given the breakdown of the amounts injected by AMCON bank by bank. In conclusion, Mr. Chairman, from the foregoing and based on the prescriptions of global standards, the regulatory authorities have acted, I must say, prudently in the actions taken in respect of all the intervened banks in general and in respect of the 3 failed banks in particular. Any other option or inaction on the part of the regulatory authorities would have had severe consequences on the banking industry and by implication the capital market and on public confidence and on the economy. Therefore, the various measures taken by the regulatory authorities have helped to revamp the capital markets. While the need to resort to evolve a robust banking system through all the measures taken by the authorities are important for revival of the capital markets, as we said, given its dominance, the following recommendations, Mr. Chairman, may be considered. One, obviously, the need to strengthen the regulatory framework for the capital market. 2, the NSC, which is well aware, a self-regulatory body, should address the issues of corporate governance for it to be effective in the capital markets. There is need to put in place a consumer protection scheme for small investors. Consumer protection scheme for small investors in the capital market, as is in the case in the US and some other jurisdictions. That should assist the orderly development and growth of the market. And of course, there is need to enhance financial literacy so that our investors, our depositors know their rights and know where to invest, where to keep their monies, and so on and so forth. Now, Mr. Chairman, I listened with interest to the issue of protection of investors. And like we stated clearly in our law, we are empowered primarily to protect depositors, and that's what we strive to do. But that is not to say that, investors, particularly small investors, should be left high and dry whenever there's a crisis. And I recall that about 2 years ago, after we visited Malaysia Deposit Insurance Corporation and also the Bank Negara, Central Bank of Malaysia, we were informed of the fact that, given the concern by the Bank Negara, Central Bank of Malaysia, to the plight of investors, they mandated the Malaysia Deposit Insurance Corporation to come up with a compensation scheme for small investors and insurance, certain classes of insurance policy holders. Because again, the question is, what's going to happen should some of these insurance companies go under? Who is going to bail out, so to say, the small insurance holder who has life insurance or accident or motor vehicle insurance? And when we came back, we made this known, particularly at our various meetings at the Ministry of Finance, which are usually chaired by the Minister of State for Finance. This was during Dr. Ganga. And SEC was there, the Insurance Commission, among others, were there. And we tried to sell this idea that for us to achieve the deepening and the strengthening of the capital market and indeed the financial services industry, we need to go extra mile, not just to protect bank depositors, certain classes of bank depositors, but also these other groups. And the reaction was that, well, there are some provisions, I think both in SEC and also the Insurance Commission for that. I don't know the details. But we suggested that what may be if both SEC and Insurance Commission's provisions may be in implicit protection scheme. Some funds may be there, but what we are suggesting is that there should be a well-established, legally backed institution that can handle this. So that whenever there are problems in the capital market, small investors, can have some support. In Turkey, for instance, I understand, again, arising from the financial meltdown and their experience, they have developed an institution that was deliberately set up by the capital market, by the government, I think the Central Bank of Turkey, to do just that. They have a way of assessing, the viability, the safety, the volume, and everything of, for instance, the stockbroking firms. And they make them, I'm not sure, because we wanted to study index. They either make the investors or the stockbroking firms, they make them contribute, somebody contributes to the fund, so that in the event of any collapse, a small investor will file his claim, just like we do with depositors, and it will be assessed and you'll be compensated. Now, in the case of, for instance, policy, what happens in Malaysia is that if your insurance company goes under, your policy will be transferred, just as you may probably transfer deposits. Their policy will be transferred to another existing, entity, and life continues, and you are covered. And that way, you will obviously achieve confidence in both the capital market and the insurance industry. So, Mr. Chairman, again, I know that we have worked on the Financial Ombudsman law, and this, I believe, is before the National Assembly. This is a law, again, which seeks to protect all consumers and to come up with a framework with an institution which is quasi-judicial, which has some quasi-judicial powers, which will be populated by retired judges, by credible NGOs, by retired bankers and what have you, which will address concerns and disputes arising from any financial transaction, whether it is your PMO that you think is cheating you, whether it is your bank that is cheating you, whether it is whoever is cheating who. You have to follow this financial ombudsman, file your case, they will look at it and try to resolve it and issue orders to whoever needs to be sanctioned. That way, the cost of litigation and the propensity to litigate will be addressed. We don't have that, but we thought it's an important area that will help boost confidence, because again, like I said, we had a public hearing about 3 years ago which bordered on the role of the banks, and the hue and cry has always been that the banks have been ripping off innocent customers, because most people don't know what's happening, the various charges and so on and so forth. So I think, Mr. Chairman, if we get an accelerated treatment of this pending bill, it will go a long way in ensuring that depositors are well protected. As we are aware right now, what happens is that cases of disputes, arising from banks and customers are adjudicated more or less by the banks themselves under the auspices of the bankers committee, and you cannot easily adjudicate against yourself, so to say. Mr. Chairman, thank you very much.
Great, yeah. And as much as possible, you try to also toe the line of the director, the deputy governor of the central bank. Everybody seems to say, okay, it's not my baby. It is the baby of this other person, we should deal with it. But my question, one, FDIC is a member of the Financial Regulatory Services Committee, is that correct? Yes. Very well. When you get to this committee, what do you discuss? Number two, if you agree that the financial system is a combination of the money market and the capital market and all of that, shouldn't we normally ask, some of these questions that we ask, they may be inquisitive. But the truth of the matter is that we are representatives of people. These are questions that somebody in Canada is asking. And he expects me to do justice, and even everybody here, somebody from Ekiti is expecting that these are questions that I want to hear. Ostensibly, we are thinking of restoring confidence to the investors. So, it is time to say, when all of you are gathered at that committee level, what affects the heart or what affects the head, what affects the leg should be your concern. Not to say, oh, I'm dealing with the head, I'm a doctor for the head, I am not concerned about what's happening to the leg. Number two, you have also cited very impressive provisions in other jurisdictions. It is a clear-cut demonstration of a government or governments in those places, in those climes, that are very sensitive to know that if this happens to Mr. A, even though it's a depositor, and is injurious to Mr. B at the other side of the coin, that it is the onus rests on government, irrespective of regardless of what the constitution or what your act says. They should be factors. I just cited the example of Malaysia and Turkey,
And I think at that committee level, this should have popped up at some point. If the CBN governor had succinctly said, I will act within my own confines and deal with depositors, I expect that he should come at some point that what of the other guys. Because at the end of the day, it is not difficult to trace. 50,000 at the minimum. 50,000 people are buying all of those shares and all of that. Are we saying that it doesn't matter? There should be something that I think, and I want you to react to that. And then in 1989, when the first distress happened, you're aware, okay? What did NDIC do? Today, some kind of distresses, we've gone through the cyclic period of distresses. I want you to situate what you did in 1989 in the context and realities of what you're doing today, and see and convince Nigerians that this is the way out. And thirdly, you said the big banks were accepted by the shareholders. No, it was the deputy governor who said that. The big banks were accepted and supported by the shareholders. But is there anything to show that they were given opportunity to participate in what became or what will become of the fate of those institutions? And lastly, we would expect that you furnish us with certificate of incorporation of these three new banks, the CO2 and CO7 of these new big banks. Thank you very much.
It's invited, more or less, as an observer. The whole idea is that we have appreciated the interconnectedness of the various financial institutions. The website, we have a common method every year. We come up with programs and policies. For instance, the financial ombudsman laws that I mentioned. There are not less than, in my recollection, the CBN Director Legal is here. We have initiated not less than 12 or more different legislations that seek to enhance the financial services industry. So that's another thing. Now, one of the things we try to promote is what we call consolidated, supervision. Risk-based consolidated supervision. Consolidated in such a way that each and every player, each and every, supervisor, you can create a team, okay, comprising the CBN, NDIC, PEMCON, and so on. And then if, for instance, you have a holdco, we have now brought introduced holding companies, whereby this which allows the banks to operate not strictly, as banks, but they can also take on other functions, other trading functions, the insurance, capital market, and so on and so forth. Now, for a bank to qualify as a holdco, there are certain regulations and standards they must have. I'm aware of the fact that some banks have got approvals in principle to operate as holdco. Now, where you have that, you have complexity, you are going to have size, you are going to have interconnectedness, and so on and so forth. Therefore, CBN alone and NDIC alone cannot satisfactorily, supervise effectively all these conglomerates. So that is the essence of introducing consolidated risk supervision. We are trying to develop capacity in that area. As a matter of fact, last week I attended a program, just to give you an example, at the Financial Stability Institute, which is an arm of the Basel Committee on Banking Supervision in Switzerland. And I proposed, and just today I sent an email after talking to Dr. Morgan on board that we need to bring in these experts to help train us in the area of identification and managing and supervising globally, systemically important banks. And that is what they call domestically, systemically important banks. As we know, we have regional banks, we have state banks, we have regional, national, and international banks. So one of the areas we need to focus is to effectively come out with a supervisory and regulatory framework that will address banks that are conglomerate, that are interconnected, that have foreign exposure, their branches outside and so on, that may be difficult to substitute because of their size and complexity. That is what they call substitutability, and so on and so forth. So these are some of the things we are addressing in this forum. And another critical issue is the issue of integrated deposit insurance, which I mentioned, which Malaysia has come out with, which Turkey has come out with, and some other institutions. We are champions of that. And as we speak, there is a committee, a subcommittee of the International Association of Deposit Insurance, for which we are members, which has recognized that there is need to develop this framework of integrated deposit insurance globally. The committee is and that's why, like I said, since we visited Malaysia 2 years ago, even though we don't have the details, we have been sensitizing and we have been advocating, and we even mentioned this during our meetings of the Financial Services Regulatory Committee and the NEIC. We promised that we will study this in depth, and we are encouraging tech and also insurance to do that, so that we can come up with a joint paper on that.
I think part of this committee, most of the answers that are given are actually for the depositors. The financial interest in that. But I think what you was also saying, because for instance, we do the work with another division, have some provision property has. Those are good. And when forward-going issues, where the capital markets have then come up with things that this committee should do to help 50,000 investors that have lost their investments in the market. Again, at any point in time we discuss this, or you have some kind of template like you have in other issues for this matter.
Thank you, sir. To be honest, I cannot remember any time when this matter was formally and seriously addressed in my recollection. If I situate what happened in the early 90s and what has happened recently and the various federal resolution actions we took, I don't know for instance, how will I react? If I get the question correctly, what I want to say is that during the 90s, we were, like I said, compared to liquidator of 48 banks, managed banks. As we speak, even though it's an ongoing thing, some depositors of these banks are yet to collect their funds. Born in the air, TV, audio, everywhere, phone on them, come forward and claim their just like there are many factors that contribute to that. Most of these people from our side are less than in the past. A lot of the depositors might have moved from one place to another. Some have lost interest, some are small, actually a lot of them are small balances sitting in dormant accounts. But yet these are huge. In terms of the issue that is a couple, maybe after 6 years or 5 years or 3 years, you can make the entire process. Whatever comes, it doesn't come fine. In our own case, even our peculiarities of the extended. In fact, recently, you notice for papers, about 3 weeks ago, we had but we had an argument. Was helpful, but at that time, the issue of which country, in my recollection, was nowhere, was never advanced by any institution anywhere in the world. So it was a recent development, and because of our interactions with the Federal Deposit Insurance Corporation and many other international players, we came out with this issue of refund, which, by the grace of God, the National Assembly appreciated and allowed us to start in our revised act. And like we said, this has helped in very many ways to engender confidence and protect our developers. Taxpayers' money, is not directly involved. NDIC is not, invested for it. So again, during the crisis of the 90s, before we embarked on litigation, we, in some collaboration of the Central, we undertook some control. We took over the control and management of the district banks. But these were largely small fragmented banks, in those states. And taking over management and control of these banks will largely depend on the acuteness of the situation. Some were rehabilitated. I personally participated for 1 year as an ED in one of the banks. And the whole idea was to conserve the assets that were there, to document the financial condition, to document the ills that were perpetrated, and to prosecute those that needed to be prosecuted, and to give the shareholders the chance to recapitalize, pay the goods, the banks that they needed. This was largely, particularly during the era of the failed bank decree. So some of them made they launched, some of them got new investors, a lot of them fell by the wayside. So like you see that in Arlo, there are various regulatory interventions, like the DG-CBN confirmed. After the 2009 special audit of these banks, we discovered that 10 of them was very stressed, and for which some liquidity support was to be given. Time frame was given to all the banks to go out and look for shareholders for investors. And it was an ongoing process. We are not directly involved. It was a matter between the bank's boards and the various shareholders. I don't have the statistics now, but we have, and I can supply you some statistics from the deteriorating condition of all the banks, particularly those three intermediate banks, which led to the intervention. Because, like we said, not to intervene would be a very grievous mistake. So giving you statistics of the number of officers, customers, deposits, branches, jobs that were saved. But I believe that in the process, shareholders were given ample opportunity to say that, look, your shares are zero, they are negative money. This time, go and look for investors. That is my thought. And like the EE said, I am even looking of a situation where one of the banks, we had series of meetings in the sector, where they were ready to not go to bed, if you like, with another on an investment company, which had a questionable source of funds, and so on and so forth. And we did our due diligence. I said, as far as I was concerned, this company does not qualify to own you. And if it is your prerogative, we had a meeting with the HR, and we said, up to you, if you don't want to be acquired or want to do this one, fine. It's not at all. At the end of the day, that same bank, maybe you have no implication, wrote to say that, they would rather be taken over by them. And that was what happened. So in a nutshell, I believe that the shareholders are given due opportunity to protect their investments.
And from the variety of complaints, coming out from the public and other people, I want you to comment on this option. Before the issue of rich banks is addressed, there is the option contained under Section 38, which
stipulates that the corporation, in consultation with the Central Bank of Nigeria, may take over the management of the firm insured institution until its financial position has substantially improved. Or B, direct specific changes to be made in the management of the firm insured institution within such time as the corporation may specify. C, arrange a merger with or acquisition by another insured institution or contract to have the deposit liabilities assumed by another insured institution, in which case other procedures will be followed. Why did you not give opportunity for such an exercise? So do you have any compelling reason why?
Like I said, taxpayers' interest must be protected. Depositors' interest must be protected. In Christian banking service. Now, like I said, that in the past, when we had small banks, what was room on other banks, all over the age, these were insignificant. We didn't have some of these measures. We embarked on takeover and management control, for a period. Now, whatever we do, there will be more of that. We could have been accused if we had again taken any options, if we had taken over the management and control of those funds, even for a temporary period. I bet you the same shareholders would have complained. So there is no way you will stop complaining from anybody. And like I said, the option that we took was in the best interest of the system, was in the best interest of depositors. It was not cost effective. But what is important is cost effectiveness to the banking system and to the financial system. You can just take over and manage and control. But what's going to happen from the statistics that the DG read out? These funds continue to live on life support. This money that they enjoy as facilities from the central bank are fixed money. And we really want to continue with that. There was a situation that when John Paul, you may recall that there was a fraud, more or less, which was conducted, I think, by late Professor Anuka. Professor Anuka, during our charity, examine the entire system and structure and process and functions and all that the central committees at that time. And one of the issues that cropped up was this issue of lender of plastic goods. Because we discovered that a lot of the banks were over-enjoying that facility. But of course the central bank has always. So we learned from some of these antecedents and we try to protect public interests.
Visions of external laws. I want to take you through that section 39 because I love going back to school. And in the course of doing that, I was generating my questions. Now, section 39, 1, if you know, says the corporation, in consultation with the Central Bank of Nigeria, may organize and incorporate. In the case of the nationalized bank or the breach banks that we're talking about, was it NDIC that organized and incorporated these other banks that we matched? I'll ask series of questions as we go on. Yes.
Shareholder. Am I right if I were to make that assumption?
Because we were thinking about nationalization, we are nationalizing this institution. So, what is the position?
At the point, like we stated, where we arranged and incorporated families that inherited or which took over the assets of the liabilities of those three institutions. After which, CBN gave them a license, banking license. First, we incorporate the company, then we give it a banking license. The moment the banking license of those outright banks were removed, they ceased to be banks. They became ordinary companies. Now, we handed over to Ampon because Ampon was there. If Ampon wasn't there, obviously, we would have been starting with the direct responsibility of managing those institutions. Now, as we heard,
let me interject. Sorry, I want to say something about that. Because the problem why we're doing this investigation is that we're supposed to even expose the weaknesses of our law. Now, within the contemplation of section 39 of the law, I can't see anything about Ampon there. The procedure, the process is clearly laid out. If you are structuring a bridge bank in line with the provision, but what you have done now is that you just set up this institution and transfer them to Ampon. And that is not within the contemplation of section 39. And if we discover that there was some kind of weakness in our laws, all that we needed to do is to refer these measures back to the Parliament so that the law can be amended. Now, if it turns out to be that you handed over these bridge banks to Ampon in contravention of section 39 of this law, are we free to infer that what you did was illegal in the circumstances?
That's why there is no reference whatsoever to Ampon. Secondly, the fact that we are empowered to transfer assets. What we did, like I said, was to transfer assets and liabilities from the acquired bank to this new bank. Ampon, bought over shares of these banks, okay, and became the new investor in these banks. If Ampon had not existed, we had the option of going along to some of these provisions. And to that extent, I don't think that what we did was in violation of the law itself. Now, I have had comments from various people saying that in fact the coming into being of Ampon seems to have really eroded or encroached into our own statutory responsibilities. But I think because we don't see the establishment of Ampon as a rival or parallel organization. We see it as an attempt to further strengthen the financial services industry. Many jurisdictions may have a similar arrangement whereby you have a central bank, you have a deposit insurance organization. In some cases, you have even a different body supervising, for the capital market, and you have asset management companies. Now, for instance, in the United States, they do not have an asset management company because the market, both money, capital market, insurance, everything is well developed to the extent that non-performing loans can easily be sold, bought and sold by anybody, by specialized institutions. These are private entities, and that is what explains, the novel idea behind the establishment of Ampon. Maybe 10 years down the road, whatever Ampon falls out, and whenever we have markets, non-performing loans, the story will be different. Now, sir, as we speak, we are settled equally with the management of non-performing loans arising from the liquidation of these 48 or so banks, which have been in our books for over a decade and a half.
Sorry, let me give my final take on this. Executing this law, the NDIC law, as passed by the National Assembly.
Now, this law has clearly specified your duty with regards to a breach ban. You are not being called upon, you are not being called upon to enforce AMCON Act. That is not your responsibility. But what I'm saying is that in the context of what happened, where in this law, NDIC Act, can you call to have battled the particular action you took to transfer these breach bans to AMCON? I want to know where the provision of the law.
I will probably go over the entire section so as to satisfy you about the legality of our action and our reliance on that section. Can I help us? Yes, I will go through section 38D. Section 38D. Fire, manage and dispose of impaired assets of a failing insured institution, either directly or through an asset management company, and the board of the failing insured institution shall be obliged to offer the assets of the failing insured institution for sale to the corporation or the asset management company, or a security for loans from the corporation or the asset management company. Sorry, I can't read the big large from my top. Management company, sorry, and the file indicate that as an issue, we propose the establishment of a asset management company together with the central government. So now, is saying, well, being a company that is incorporated under the Corporate Affairs, Corporate and Allied Matters Act. So are we
Thank you.
CBN, Center of Commission of Finance, the National Assembly Standing Committees in the Senate and the House, and it specifies exactly how AMCON should be run. I understand your concern, but the board of AMCON, the MD was nominated by the Senate Bank of Nigeria, but was appointed by the President. The Central Bank governor cannot fire the MD of AMCON, only the President can do that. The reporting relationship between AMCON and the Central Bank is one of regulatory supervision. But contrary to what people say, my boss is the President of Nigeria, not the CBN governor. Additionally, the major failing of asset management corporations all over the world has been interference from political heavyweights who want their friends to buy something or want to give their friends something. And so, a lot has been made very wisely of the National Assembly. And I always commend this National Assembly for passing the AMCON Act that makes it clear that neither the Minister of Finance nor the Central Bank of Nigeria governor can tell AMCON what to do except as specified in the Act. I, being the National Managing Director, will tell you that I am very, very jealously protective of the independence of AMCON. I can state categorically that the Central Bank governor, both Minister of Finance, there was Dr. Adanga and now Dr. Okoye-Iweala, has ever tried to interfere with the independence of AMCON. But it's a good point to raise, and I think it is useful that all of us watch what AMCON does, how independent this function is, and if anything seems to be tilted, I think it's useful for everybody to bring it up. And I'll be very, very open to any discussions if you see AMCON compromising on independence. But I appreciate your concern and we're very aware of it.
I not speak where section 4 and 5 says you are independent of anybody. There is no such thing. Then section 8 says that the Central Bank of Nigeria, in consultation with the Federal Ministry of Finance, may issue guidelines and directions in writing to the corporation in connection with the performance of any of the corporation's functions under this Act. Any of your functions, the CBN can regulate you, it supervises you. Then, and conditions of service of the managing director and the executive directors shall be determined by the board from time to time, subject to the approval of the Central Bank of Nigeria. So, whatever you do is regulated by CBN. You are not independent.
Mr. Chairman, very, very seriously to what we here. I have very serious objection to the fact that we got a letter from this committee to come here not as a person, but as the MD of AMCON. And I believe that ultimately a presentation from AMCON is very important. This is not a knee-jerk thing. You can't just stroll in and then feel like you can just talk to us and walk away like that. And on behalf of the chairman, I believe that we will demand a presentation from you in formal form. That's number one. Number two, my two questions. When you were appointed, what did you find on the ground? What were you appointed to fix? That's number one. Number two, where is AMCON headed today? Number three, what do we judge AMCON by in another 2 years? One, from the perspective of shareholders. Two, from the perspective of depositors and investors. Because the whole of the financial system, they are all moving together. And AMCON has come in now as a major player. Thank you. Section 1.4 is the reference I was making. I said section 4 is taken in. And I'm searching for another section without finding it. But it is section 1.4. It does say that. I
I apologize to the honorable member about the presentation. I received this letter this morning, and I came with this letter this morning. I received this letter requesting this information this morning. It would have been physically impossible for me to respond to the presentation having received the letter this morning. It's dated 30th April, and as well, yesterday was a holiday. So I apologize. I will have a presentation ready for you as soon as possible. Referring to this letter. Secondly, I just want to point out that AMCON has 190 employees. With the 190 employees, we have issued more bonds than the debt management office has issued, with many more employees. We have the largest number of assets of any bank in Nigeria, and those banks have employees in the thousands. We are aware that we are a self-liquidating institution, and we must work very lean because as time goes by, AMCON should get smaller and smaller. And the last thing we wanted to do was to create a mammoth government organization that will have forward liquidating as time goes by. So I'm asking you that I do not have special assistants that will write presentations for me at the drop of a hat, other organizations have. So I will go back and I will work on this and I'll get it to you as soon as it's possible. But I did this today. So I apologize for no presentation. To answer your questions, what was AMCON appointed to fix? AMCON was created basically because the size of the financial problem was unprecedented. In the United States of America, in the last 3 years, they have closed down 900 banks. Liquidated 900 banks, the auditors got the minimum guaranteed investment, and the shareholders lost everything. But America is so big that 900 banks doesn't ripple the economic fabric. In Nigeria, the 8 banks that we have represented close to 30% of banking assets. It was not a big problem. It was not susceptible to all the fixes we have discussed here. NBS doesn't have the capital to assume this bank and management. The amount of money we put in bank PHP, which became Keystone Bank, was about 300 billion naira. NBS could not capitalize that PHP, and the only alternative was to liquidate bank PHP. If I don't keep on PhD, that bank has been liquidated. We had about 500 billion in deposits. Of those deposits, about 300 billion were public sector deposits. That means that public institutions in Nigeria will have lost 300 billion immediately. It's not just private individual deposits. Many of these deposits that we're talking about are public sector deposits, which comes back to the government. So that's what I wanted to fix. I was appointed to create an organization that will very quickly address a unique problem. I don't think that nobody has mentioned here that all these banks, 8 of them, were losing an average of 2 billion naira a month. So every month you waited, you have a 16 to 20 billion naira additional problem on your hands. The reason why they were losing 2 billion a month was they all had negative equity. To fund their operations, they were borrowing money in the interbank market at 16% to fund their operations. No bank will survive with that. So it was a ticking time bomb to liquidation. The longer you waited, the bigger the problem became. So when we came on ground, we had no employees, we had no offices, no cars, no infrastructure. And we have to buy all the non-performing loans from the banks, the federal banks, by the end of the year 2010 because of accounting issues. So we had 6 weeks. We operated out of temporary offices. We had no staff. The 4 executive directors worked 18, 20 hours a day to make sure that we got this loan by December 31, 2010. And that's what happened. So we came to fix a very urgent problem. It was not useful for the authorities to explain to the public the size of the problem because it would just bring panic. A situation where you are losing, across all the banks, every month, they are losing 20 billion naira. So, when we talk about central bank and its deadlines, central bank was aware the problem was worsening every month by 20 billion, and something has to be done. This crisis occurred 2009. Banks were given 2 years to recapitalize. The first deadline was June 2011. 2 years that those banks were given to capitalize. When they couldn't do June 11, they were extended to September 30th. That was the second extension. When somebody has spent 2.5 years trying to capitalize the bank, that's worsening by 2 billion a month, it's difficult to say keep them water. It's difficult, it's irresponsible, it's practical. So things for the ticking time bomb. And when people talk about lack of confidence in what happened, they don't understand what could have happened if that hadn't happened. If you had allowed $1 trillion of deposits to go to the air, most of those deposits were to other banks. So some of these so-called healthy banks would have had to lose a lot of money immediately those banks got liquidated. So it's a complex thing, and you make the best judgment you can. You make it in the best interest of the major people. We talk about 50,000 investors. We have 10 million depositors. And when the depositor goes to the banks, when the depositor goes to the bank and hands them their money, they expect to get it back. Investors should not think like that. Investors should not believe that when they go and they make an investment in an institution, that they will get their money back. And no government should entertain the idea that investors who take risk, who get upside, should not be subject to downside. If government starts doing that, where are we going to stop? Airline industry is collapsing. Airlines have a vital role in the Nigerian economy. They collapse. Then you want to national center and give us that money? Okay, and it's a very tricky thing to say. Depositors rule in banks. If you want a bank, you must think of the depositor first. Everyone will let it done. And in these banks, because let me talk about this, in these banks that were nationalized, I will be very about to say nationalized. Because the nation owns it, and AMCON is just a trustee for the nation. I will say that clearly. In those banks, AMCON owned 54% of the old Africa before the action. AMCON owned over 75% of the Spring Bank before the action. And AMCON was the largest shareholder in bank PhD, I think it was 18%, but having bank owned by the good of the bank. So in all of those cases, AMCON function as a shareholder was pursued by AMCON's responsibility to the financial system. And I went to the new enterprise bank on Monday. I went there to the headquarters in Lagos. And investors, the depositors came in and took their money out. And I said, take your money out, it's safe. And they came back to them and put the money back in. There was no law in the Nigerian bank after such an action. I think that what we came to do was to stabilize the system. And I think we've done that to date. The other question is, where is AMCON headed? I will tell you this. There was no intention or desire for AMCON to own any bank. We will dispose of these banks as quickly as it is practicable. That's why we will love that state nationalization. We don't interfere with the banks, we don't run them, we supervise them, but we want to sell them because national policy is that government should not be in the business of owning banks. And we will adhere to national policy. The reason why Mr. President was consulted why we did the action was because he would have to explain to you why the national policy of not owning banks was in this case being breached. It was a very difficult decision. We're not happy about doing it, and we will be getting rid of those banks as soon as it's practical. That is intention of AMCON is not equipped to run banks, and we certainly are not comfortable until we get them back to where they belong. So we are headed to disposal of the banks. We are headed towards restructuring all the non-performing loans we acquired in such a manner that will not disrupt the economy. I'll give you an example because it matters to you. There is a time we acquired the loans. It was easier for AMCON to liquidate the loans and take the aircraft. The aircraft are worth more than the loans. But that airline was directly remunerating over 20,000 Nigerians. It flies most of Nigeria, and the decision was made, let's keep this airline alive because it's important for Nigeria. So part of AMCON's job is not just to resolve the banking issues, but to resolve issues with some debtors who may have overextended themselves, whose loans are not exactly compatible with their business model, or who run into hard times because oil prices dropped or the economy went down. So our job now going forward, A, is to work with the debtors and restructure their loans so that it doesn't hurt the economy, and B, together with those parts, and if we can do two of them, I'll be very happy to have a much smaller AMCON 5 years from now that employs 50 people and just manages these two assets. So that's all. I hope I'm answering the question. Okay.
Well, it is. This means that the eventual burden of AMCON is raised with the Nigerian taxpayers. Is that? On the surface, their bonds are therefore made a more attractive product in the capital market, perhaps by fiat. And it appears plausible to say that AMCON is crowding out other issuers in the market. And AMCON is also viewed as worsening the Nigerian domestic debt problem. What are your views on this?
And I say that because everybody, including the international agencies, have answered those things. So it's a very timely question. First of all, AMCON are guaranteed by the government of Nigeria. But AMCON bonds will not be repaid. The concern everybody has had is where will AMCON get these funds to repay those bonds? And I will go through some of it very briefly because we do have, like I mentioned, we have a presentation to the National Assembly tomorrow where we go through everything about AMCON, including everything we issue, how we're going to get the money back. But I'll give you general terms. AMCON gets its money back from three sources. Recovery from non-performing loans, recovery from the investment is made in equity from banks, and thirdly, the banks are contributing 30 basis points of their total assets a year for as long as it takes for AMCON to be self-funded. So the banks will continue to contribute 30 basis points a year until AMCON is fully funded. So the federal government will not pick up the pen. This was the concern of Standard & Poor's when it came to rate Nigeria. Standard & Poor's came with the attitude that AMCON bonds should be in Nigeria's debt profile. We discussed with them, we showed them our model, and we agreed that AMCON bonds will never be part of the federal government debt. Same thing with Fitch. And when Fitch was upgrading Nigeria, they mentioned that AMCON was not going to be part of the debt. If you want the exact numbers, we're going to get 60% of our money from the sinking fund, roughly 60%. We get about 25% from non-performing loan recoveries, and we get the balance from our investment in equities. We are currently the largest holder of public equities in Nigeria. We are also the largest lister of bonds in the Nigerian Stock Exchange. So we are very, very interested in the capital markets as a whole. Because we are both a large investor and we are a large issuer. But AMCON bonds will not ever, the guarantee will never be crystallized. And we can show you that in excruciating detail, as we have done with IMF, with the Standard & Poor's, and with the Fitch rating. But we will give some commissions and we'll show you exactly how we pay for account. As for the contract question, which you mentioned, we have the issue of contract will emerge in December 2013 when we refinance our first bonds. But the bonds we issued were given directly to the banks in exchange for their non-performing loans. So we took non-performing loans and gave them a better asset. So it was not sourced from the Nigerian market. There was no money from the market that went into our bonds. It was an asset exchange. But when we refinanced the bonds in December 2013, the issues of whether or not we may crown out other investments is a legitimate one. And the roadshow we have in New York, in Boston, and in London is to attract international investors to Alcon bonds because we're looking ahead 18 months. And we want to make sure that when we refinance, that there's international interest so that it does not, in fact, run out of local debt.
Arising from the non-performing loans, I think this is one of the major financing you said you were correct?
Yes.
How far have you gone with the recovery of the non-performing loans? How far? What's the report?
11. We will not recover any non-performing loans. We assume 2011 will be an acquisition year of non-performing loans. And we will start the process of recovery in 2012. That was the assumption and our model. Luckily for Alcon, and thanks to the very robust Alcon Act, we have a lot of borrowers coming to Alcon and saying, we want to settle. We don't want to deal with Alcon, we want to settle. So last year, we recovered approximately 500 billion naira worth of non-performing loans. And we have 500 billion. We are assuming zero. So we are way ahead of what we're planning. And we plan that by the end of this year, we should have recovered roughly half of what we acquired.
This recovery, isn't being discounted or what value? I mean, are you discounting this bad loans or non-performing loans or the selling at the market value?
More or less than we pay for the loans, except for the permission of the central bank governor and the permission of the Ministry of Finance. So we are recovering roughly 118% of what we paid for the loans, more than we paid so far. We expect that the non-performing loans will come later, but we're ahead of, we're 118% average at this point.
Are you satisfied that the Alcon model is working in that by taking over the non-performing loans, I think we are now letting the banks with a liquid line. Many should be in position to lend. Are you happy that that's what exists today is lending in Sudi?
Yes. Honorable members, the success of Alcon and all the regime is how the banks perform in lending to the real economy. Anything else is not. The banks must perform their function of lending to the real economy. In fact, Nigeria is so underlent that the banks need to grow at an average of 30% a year to catch up to other countries like, I think, Egypt, South Africa, Malaysia. So we need the banks to do what they have to do. Last year, we had projected that the banks will not grow at all because they were giving access to our club. In fact, banks grew by 16% in lending last year. We believe that banks will lend well over 30% this year. And we are hoping that this cleanup, this massive effort by government and other stakeholders will lead to the banks being able to lend to the real sector. I think the DG mentioned improved in lending to agriculture. I think there are other things we can do as stakeholders to make sure that the environment is healthy for the banks to lend. Because we don't want banks to go rapidly again and then have another annual problem 10 years down the road. So it's a balance between creating bankable assets and bankable asset value and growth. And I think so far so good. But I think that we need a year or 2 more to be able to declare victory.
That suggests to you that you're privately owned or you're mainly privately owned?
But most of AMCO's success will depend on the powers of recovery that the National Assembly gives. It has extensive powers of recovery, and that's what people are coming to pay. So, if it didn't have those powers, I don't think the banks would be quite so willing to contribute. So I think that it's a public institution with a lot of private support. And before we become too kind to the private support, we saw the GT Bank just released this first quarter report. Very impressive. I don't think that they will have had those kind of impressive numbers. Apparently there was 100 billion a year base. I don't think they could ever have gotten there if the banking system as a whole had not been satisfied.
Finally, if it's not totally in place in the financial sector, what will be your reaction, or how will you react to that situation? Because clearly, like I said earlier, the idea is to create that space where lending will be the order of the business.
President, and between now and 2 years, I will do everything in my power to make sure that that's not the situation. But I'll be very disappointed if that's not the case.
If you tell us what
the military power whatsoever. We don't regulate anybody. We are a resolution vehicle. So what AMCON can do to banks is very limited. So what we are trying to do is